Welcome, everybody. How to sell credit spreads for income with Don Kaufman. I am Don Kaufman. I'll be your host this evening. I will also let you know you can feel free to chat in some questions as we do go along tonight. I try to read as much as I can while I'm going through this. And I will be able to answer some questions towards the end of the presentation tonight. A couple little disclosures up front. First of all, we are not financial advisors or a broker-dealer. The reason I mention that, well, the previous 15 years of my career, well, that's what I was. I happen to be a financial advisor and a broker-dealer. I'm no longer, again, in the brokerage side of the business. The other aspect, this presentation is ours. This is not yours. However, we will provide you a copy of this presentation. The other thing is, if you ever need to get a hold of us, this is our address here in Scottsdale, Arizona, our phone number. And of course, if you ever need to get a hold of me on email, by the way, we answer emails. When I say I answer emails. We probably get a few thousand emails per week. Support@TheoTrade.com goes to a general inbox for all of us. So by all means, feedback, questions, comments, email us. We're here to support that. Now, this is a little bit about me. I'm getting older, losing a little bit more hair. Co-founder here of TheoTrade. Now, prior to TheoTrade, I started my career in the late 90s in Chicago, in trading in Chicago. Shortly after I started trading in Chicago, I was invited into, at the time, was a startup brokerage firm. That firm progressed into what is known as thinkorswim. And again, was there very, very early on from 2000 all the way until 2015. Actually, this is almost 3 years to the day since I hung it up from TD Ameritrade and thinkorswim. I've had a 19-year trading career. Actually, this is the 20th year in my trading career now, and 17 years of thinkorswim platform experience. It's a little bit about my background. I've done the wonderful CNBC tour, and I always like to say this, but if you're going to be pitted against somebody, this is the gentleman that you want to be pitted against. Mr. Wonderful for himself. He was long apple, I was short apple. Again, this is going back a little time, but we laughed, we cried. I got to beat him up a little bit live on CNBC. Every trader's dream. A little bit about TheoTrade. TheoTrade, we specialize in education for stocks, options, futures. We even do get into some currencies out there. We're founded by professional traders and trading educators. Each of us have a minimum of 15 years of experience. Many of us with several decades. And first and foremost, people, well, what are you going to teach me here? Well, we're here to help you mitigate the risks, navigate the markets, and really learn a skill set that's going to last a lifetime. The other aspect I feel very, very strongly about is that TheoTrade, it's not just myself. Okay, it's not like, Don Kaufman. We have on board Doc, better known as Craig Severson. Everybody familiar with Doc Severson? Jeff Bierman. Jeff Bierman actually worked side by side with me at both thinkorswim and TD Ameritrade for about 8 years prior to Jeff also kind of retiring from TD Ameritrade. And we pulled him aboard here at TheoTrade. Just about, Jeff's got about 18 months now with us. We have Steve, better known as Slim Miller. That's 43-year stock options and futures trader. Actually, Steve was down there when they started the Chicago Board Options Exchange. And last, but definitely not least, Tony Rago. It's our intraday and NASDAQ futures specialist. So right now we have 5 full-time instructors here ultimately at TheoTrade to assist. And that's what you're ultimately learning from. What you're going to learn in this presentation this evening. Well, first and foremost, we're going to learn why. We're going to see a shift to more volatile markets and why 2018 will be optimal conditions for selling options premium. And if you're not familiar with the terminology of selling options premium, I'm also going to make that much more abundant and clear. Because when you talk about selling options premium, that's an income-based strategy. Central bankers are raising interest rates. Learn why higher rates are going to translate into opportunities for you to sell defined risk spreads. Discover how probabilities are really low in the market. So we're going to discuss probabilities in quite some depth, okay, and how you can create probability. And really, with this, we're going to talk about dialing in different probabilities in any marketplace. When I say dialing in probabilities, what does that mean? Do you want a 70%, an 80%, a 90%? That's what we're going to help you dial in. You're going to learn a couple of powerful strategies to use credit spreads so you can create consistent return. And what are the major benefits of trading, okay, credit spreads, and why so many professional traders, they use credit spreads. Let's get off and rolling here, okay, with it. Have no fear. The Fed is here. By the way, also, I like to have some fun with this. If you read very carefully, fear the Fed. So, sorry, I didn't want to make that subliminal. It just means have no fear. The Fed is here. So I'm going to start tonight with a discussion of why we're going to see pending volatility. I mean, markets have seen unrelenting complacency and a lack of volatility in recent years. And it's the degree of volatility in the markets, okay, and the lack of volatility in the markets, considering the myriad of risks on the horizon, is unequivocally remarkable. And I say the degree of volatility, it's the lack of volatility that is absolutely remarkable when you've looked at all of the risks that we've passed through. I mean, we need to go back like the last 3 years, and it was Brexit, it was the election, it was this, it was that. I mean, how many times can we have risks thrown at us, okay, and the market shrug it off? And a big portion of this is multiple rounds of quantitative easing, and the influence of the Federal Reserve policy is decisively behind both the rally and the degree of complacency in the capital markets. And that's something that I'm going to provide a little bit of substantiating evidence to that. Now, this is just a brief chart of the VIX. It's the volatility index. And when I, have that statement like volatility is just, absolutely rock bottom and it's remarkable. What's remarkable in here is when you start to box this out and you really start to look back. You're like, oh, what was that? Was a big spike. That was nothing. That's the volatility at 25. I started trading in the late 90s. Okay, it was rare to see us get down to a 20 volatility. It was rare to see us get down to a 20 volatility. And that was for the first, almost 10 years of my trading career. Now, we get excited when we get that high in volatility. Okay, this is a direct influence from the Federal Reserve. Let me explain a little bit more about that. Again, this is complacency and ultimately volatility getting crushed away. Now, I made a bold statement to begin with. We will see a drastic increase in volatility in 2018. All good Fed things must come to an end. By the way, I also didn't want to throw this one. I was having fun with this. Fed must end. Yeah. I mean, all good Fed things are going to come to an end over here. Starting in 2018. Let's just throw this out here. Starting in 2018, the Federal Reserve is effectively departing the marketplace and will commence contracting the $4.5 trillion balance sheet. Now, in a moment, I'm going to talk about the strategies surrounding this idea, but you better know it's on, okay? Please, they're contracting a $4.5 trillion balance sheet. As the Fed capital declines, interest rates will increase. They already are increasing. Today was a primary example of that. Investors and traders will be forced to unwind positions in countless marketplaces. Now, that's a big statement, and that a lot of people that may or may not be familiar with. The moment that interest rates start to go up, professional traders, they have to unwind positions. Why? Because they're borrowing capital. That's what traders do. As interest rates increase, okay, it might not make sense for those professional traders to continue to sustain those positions. Why? The cost of borrowing increases. It forces them to contract, all right, their positioning. In effect, as the Fed pulls away the punch bowl, capital markets are going to become increasingly volatile. And these are all factors I want you to think about. Now, all right, I want to have some fun with this because here comes a crazy slide for you. You ready? This is actually brought to you by the Federal Reserve. It's FactSet. JP Morgan Asset Management actually put this together. This is definitive. The information comes directly from the Federal Reserve. Okay, there's actually a database out there called FRED. Anyway, JP Morgan Asset Management originally put this together. I like to give a little bit of credit where credit's due. What you're actually looking at is the buildup, and this is going back into 2008. This is the beginning of quantitative easing, where they actually started to what we'll call, spike the punch bowl. This is where they actually started dumping capital into the markets. The increase, really ended. They kind of cut in about 2014, 2015. Nevertheless, there was a hangover effect in here where it actually peaked out. We have actually hit the threshold point. We're through it. The threshold actually started back in October of 2017. When I say through the threshold, we're actually coming down right now off of it. And what that ultimately means, by the way, this MBS, there's a lot going on in this slide, right? This is all of the quantitative easing that the Fed did. This had to do with buying treasuries. What's MBS? It's mortgage-backed securities. Other is just other bond products they've been purchasing over here. This is the forecast Fed reduction moving forward. And it's a pretty scary concept that most people are not aware of. As they start to pull, again, what we call the juice away from the marketplace, it is unequivocal that volatility will start to increase as, again, the interest rates are going to go up. So there's umpteen different reasons volatility can increase, but interest rates alone are going to be a measurable differentiation in this marketplace. All right, moving along over here. The shift to volatile markets in 2018. The Fed balance sheet, as we just saw in the aforementioned slide, the Fed balance sheet decline, it's already begun, right? They're removing again the spiked punch bowl. It is time to get back to selling options premium as increases in volatility are forthcoming. All right, you're going to have some volatility ahead. And consequently, you may already be seeing that. When people think about volatility, they only prototypically think that that's when the market's selling off. Consequently, when the market's exploding to the upside, like we've seen literally the last 6 trading sessions with markets exploding to the upside, that is a function of volatility. It is absolutely a function of volatility, and you need to be aware of that. Now, the way we're going to take advantage of this, learning to sell options. Now, a lot of people kind of heard through the grapevine, and it's kind of through the grapevine, like selling options is a great way to make money. Let's all chime in over here. By the way, you guys could be watching this on a recording, could be watching this live. It doesn't matter to me. And there's a lot of people on today. How many of you have heard that before? Like, heard through the grapevine. Selling options, great way to make some money. Huh? Anybody? Anybody. I mean, well, if you've experimented with selling options, you know full well there is definitely risk involved. And today's session, I want to separate some of the myths from the real risks and the fact from the fiction in selling options premium. And you know what? As soon as I talk about selling options, people start to panic. Don't panic. You can do this. You may know nothing about options. That's okay for today's session. It's okay. And again, if you know nothing about options, feel free to chime in and go, I know absolutely nothing. Hey, admitting is the first step tonight. For starters, though, if you're brand new, you've never had any experience with options over here, grasp the big concepts regarding probability and risk. You don't have to grasp every little nuance. Now, for those of you that are a little bit more experienced, because we get traders of all walks of life in here, right? If you're a bit more experienced, fantastic. You're actually going to start to pick up on some of what we call the criteria, the recipe to actually build a given spread out there. So let's dive in. All right. Probability and profitability. Trading as a whole is based on probability. And that's something that, again, a lot of people have a tough time with. They're like, really? I mean, every trade that you do, whether it's stocks, whether it's options, whether it's futures, you can, in some way, shape, or form, define a degree of probability in that trade. That's a bold statement. Okay? You and I can create trades all day long with a 90% probability of success. But a 90% probability of success doesn't necessarily mean you're going to make money. You know, it's funny because you go to a million different websites out there and all these sites go, follow me, look at my track record, I will make 90%. I got to tell you guys something. Listen, the buck stops here, okay? I was in the brokerage business for 15 years. There's tons of people that had 90% probability of success. That doesn't mean you're going to make money. Because you got to think about, like, 90% of the time you're making money, yeah, what's going to happen to the other, the other 10% of the time? That's like the dark side of the force that nobody ever wants to contemplate over there. You got to think about that. Probability alone does not make you profitable. Remember that. Everything you're going to do in this business, it's going to be a trade-off. Markets are a trade-off. Markets are a series of trade-offs. Higher probability is equivalency to higher risk. You can be right 90% of the time and still lose money. And that's where I like to separate that kind of fact from the fiction. That's what I'm talking about with these myths. You go to some site and they're like, hey, go follow me. I'm right 90% of the time. Okay, I can show you to be right 90% of the time right now. But that's not going to make you money. And you're going to have to follow a very definitive recipe, okay, to make this stuff work. You got to figure out, where can I find an edge? That's what people are here for, right? Great. Well, let's get into it because we're going to show you some things that are very, very important now. Discovering probability. This is what we call the curve. Now, I'm just going to freehand this a little bit. I'm going to take you through a couple of examples. And this is the aspects of trading that not a lot of people are familiar with. So we have a stock. It's a $100 stock. And it doesn't matter what this is. You know, a lot of people use like, it's XYZ stock. No, it's not XYZ. I call my fictitious stock, I call it stock. Okay? And stock is trading right at 100. Why do I call it stock? By the way, the next time I take a company public, that is going to be my symbol. I want my symbol to be stock. Years ago, it's an absolutely true story. We'll have some fun for a second. Years ago, when thinkorswim originally went public, we traded under the symbol swim. But I actually wanted to change it to monkey. So, and they would have, but we would have changed it to monkey. However, the company was acquired at that point by TD Ameritrade. It's not bad. That's not bad. That was actually a very good acquisition for me personally. However, I never got to be my symbol monkey. So absolutely a true story too. It was a fun conversation to have to a board. We should change the symbol to monkey. They're like, really? This is what the board meeting is about. Anyway, now we're actually going to use stock. Anyway, continuing on over there. By the way, again, can't make that stuff up. So the stock is trading at 100. As I said, markets are really based on probability. When you start to discover what the curve is, what that means is you have a stock trading at 100. And you look at an opportunity over there. What's the probability of the stock going to 110 versus, for example, 90? Okay. Now, this seems kind of, I guess, obscure if you're not familiar with it. But the way that the market prices risk, it prices the probability of getting to 110 effectively the same as getting to 90. The interesting thing about a marketplace is the market doesn't really know about direction. The market, like when I say the marketplace, what's the probability of getting to 110 versus the probability of getting to 90? And let's say that there's a 30% chance of getting down to 90. The marketplace would also probably price it a 30% chance of going to 110. Now, why does it do that? Because markets don't know about direction. Markets don't have technical analysis. There's a MACD, a Fibonacci, a Bollinger Band. The marketplace is rather an equivalency tool, meaning that, and I'm going to go a little bit further in here, okay, because this baffles people when I initially show it, but you could do this in any marketplace, and I'm going to actually show you exactly how to do this, okay? Many of you will look at an option, okay? You'll look at an option. And what you'll see here is 110 call. Now, you may or may not be familiar with options at all at this point. Okay? Now, again, I'm going to say a 110 call. What's a 110 call? Well, the stock right now is trading at 100, a 110 call. A 110 call would give you, if you purchased it, it would give you the right, all right, to buy the stock at 110. You're going to buy the 110 call. Okay? Doesn't matter what it costs. Let's not even focus on that right now. There's a price tag on that call. And most people would look at that call and go, okay, what's the price? I need to know. Fine. Let's put that call at $1.50. Right? Let's put that call at $1.50. However, you don't need to just know price. What is the probability? Okay? What's the probability? Why do you want to know the probability? See, this option price can actually be turned directly into a probability. That's why options are so incredibly important. And that's the one aspect, like, there's a lot of people that, I've been doing this for a long time, and I've spoken at all over the place. I mean, you name a major city, and I've spoken there, and all the time people come, oh man, that Don guy's an options guy. I don't trade options. I trade stock. Like, you know how many times I've heard that? It's now 20 years. You know how many times I've heard that in 20 years? 1,000 times. And the point that I'll make to you is, I don't care whether you trade stocks, options, or futures. Quite frankly, I trade them all. I trade stocks, options, futures. There's some people that are like, I'm an options guy, I'm a stock guy. No, a trader is a trader. You could either buy it or you can sell it. That's all that matters. You could buy it or you can sell it, right? And in this particular case, what matters and why it's so important to understand options is because the options can give you a probability, okay, of a stock getting to a particular level. Now, when you see a 110 call, you see the price being $1.50. You know what I see? I see a 30% probability of even getting to 110. Now, I will show you tonight definitively how to calculate probability from price alone. Now, that really is that's off the charts, because even if you're brand new to options or whether you're experienced, a lot of people don't know how to look. Hey, that says $1.50. No, it says 30%. And you're like, how do you get that? I'm going to show you exactly how to do that. Price is probability. Now, the other aspect of this, tonight, I'm not going to get big into, do you want to be bullish or do you want to be bearish? When I say that, here's a stock going to 90, here's a stock going to 110. Tonight, we're going to focus more on probability. Why? When you know how to dial in the probabilities, bias becomes secondary. I'm going to say that again. When you know how to dial in probability, when I say dial in probability, if you want an 80% probability and you know how to find an 80% probability, dialing in that probability, okay, is substantially and significantly more important than trying to figure out, are we going up or are we going down? Listen, that will factor in, but we have to understand probability ultimately first. And that's why I brought up this slide, just to discuss the probability curve. Now, to continue on with this, right? By the way, continuing on with this example, would you want to go out and do a trade? Like if you saw a trade and it's this 110 call, again, what does the 110 call give you the right to do? It gives you the right to buy the stock at 110. Would you go out and would you want to buy an option with a 30% chance, okay, of making 1 penny or more? Is that a fair question? Because I think it's a fair question. Would you want to buy that option, knowing that your probability of making a penny or more is only going to be 30%, right? Because that's what probabilities will help you do. You're probably going to say to me right now, anybody, by the way, these are not rhetorical questions. Jump in here at any time. Like, legitimately, would you want to buy something with a 30% chance of making a penny? Okay? And that's where a lot of people, probably not. Yet, how come people buy options every single day? They don't even know what the probabilities are. They have no clue. They're like, I'm going to buy me a call. Why are you going to buy a call? It has a 30% probability to go. How could you possibly know that? Because options are probabilities. That's what they're based on. And when I say stuff like that, it's a little shocking to people. Now, let's get into it. Let's start to talk about not necessarily buying options. Let's talk about selling options. And specifically in this case, selling out of the money options. So here's where we're going to start the discussion of selling options. Now, tonight, what are we talking about? I mean, tonight we're talking about really high probability credit spreads for income. We're talking about high probability credit spreads, okay? But first, we need to talk a little bit about selling options in general, just for you to get, okay, a brief understanding. A moment ago, I asked you, would you go out there and buy something? Would you buy something with a 30% probability of making money? No, but you know what? We had tons of people just chat in over there. We had tons of people chat in. They go, no, I wouldn't buy it. Not one person came in there and said, no, I wouldn't buy it. I would sell it. Now you think about that. Markets are a two-sided animal, okay? For every buyer, there's, okay, a seller. Now when you trade options, you can buy a 110 call, but you could also sell a 110 call. Now, before I go any further, okay, here ultimately have what? We have the buyer and we have the seller. Every time that you trade an option, you have a decision to make. You can be on the buy side or the sell side. You could be a buyer or you could be a seller. And it's still the 110 call. Buyers have rights. What's the right? They have the right to buy the stock at 110. Sellers have what? Obligations. They are obligated to do what? To give somebody stock at 110. You're like, whoa. Don, I don't even own the stock. I have nothing to do with the stock. I don't even know the stock. Okay? That's okay. You're still obligated to give it to somebody at 110. Can you sell a call without ever owning the stock? Yes, but you would have extraordinary amounts of risk. What I want you to get the notion of, a lot of people will ask this question. They go, how can you sell something that you do not own? How can you sell something that you do not own? Okay, you're writing the option. You're right, you don't own it, but you're selling an obligation. You're selling yourself into giving somebody stock at 110. Now, the stock right now is trading at 100. Let's forget about being a buyer. Let's strictly now discuss being a seller. We're going to be a seller. We're going to sell the 110 call. And for that, we're going to get a credit. You know what a credit is? That's $1.50 into your account. Now, let me ask this question, because this is another fair question. When you sell something for $1.50, what's the most you can possibly make? Now, we're going to go out and we're going to sell this call. And I am not advocating that you do this trade. But I do need to teach the sale of the call. I need to make sure that everybody's on the same page. And when you sell something for $1.50, the most you can possibly make is $1.50. You have to recognize something about selling options premium. What you get up front is called the credit. Okay? It's kind of like, let me give you an analogy. It's kind of like selling a car. You go out and you sell a car, and you sell the car for $15,000. Okay? You sold your car for $15,000. Nobody comes back a week later. Nobody comes back a week later to the deal and they go, that was the best car I ever bought. Here's another $1,000. That sounds ridiculous, right? What? You sold the car for $15,000. It's done. It's over. You hope never to hear from that person ever again. Well, selling a 110 call is similar. It's similar in respect. I sell the 110 call. You know why I sell the 110 call? Because I want to keep the $1.50. You know what the most I can make is? $1.50. The stock right now is trading at 100. I sold the 110 call. So what do I do after I sell the 110 call? Well, I pray. What do we mean you pray? If you sell a 110 call and you sell it naked, you go, oh, I hope what? Oh, I hope the stock expires below the short strike. Strike being 110. You keep the credit. You sit there, I hope. If the stock goes down, you keep the $1.50. If the stock stays flat, you keep the $1.50. If the stock goes up, as long as it stays below 110, you keep the $1.50. Now, I want to explain something because a lot of people, okay, and again, we'll talk about building this into a safer trade. But a lot of people, they look at options and they're scared to sell them. And I want you to realize something. Okay, I want you to realize something. If you, forget about selling for a second. If you buy this option, what does the stock have to do? What does the stock have to do? if you buy the option, the stock has to go to the upside, right? You got to have that stock climb to 110. 110 isn't even going to break even. You need it at 110 plus the $1.50 that you paid for it if you buy it, right? So now you need the stock even further. Think about what has to happen. You have to have this monumental move. You have to get down on your hands and knees, and prior to contrary, popular belief, but prayer is not necessarily a strategy for markets, but you're praying that the stock just goes higher over here. You know what? When you sell options, think about the probabilities in your favor. Think about this. If nothing happens, I make money. If the stock goes down, I make money. Even if the stock goes up, I might make money. Where things get scary is above 110. What happens if the stock goes all the way to 150? You're like, ooh, I don't care who you are. That is going to hurt. You know why? Because if the stock goes to 150, somebody has the right to buy that stock from you at 110. You know why people don't like this? They don't like selling an option. This is called selling naked. Okay? Selling naked's scary because the stock can go from 100 to 150, and there's been a lot of that lately. And you have to give somebody stock at 110. Now, first of all, you never, ever, ever have to own the stock. But in this case, you would lose $40. Oh, wait, but you got your $1.50 up front. But again, I want you to think about this. Don't worry about the risk right now, because I'm going to help you mitigate the risk. That means control the risk. What I want you to look at solely for purposes of this example is in sheer respect to the fact, okay, that if the stock goes down, okay, I'm profitable. If the stock stays flat, I'm profitable. Even if the stock, okay, kind of stays where? Up a little bit, I'm still profitable. That unto itself, this trade is going to have north of a 70% probability of success embedded into it. And that is critically important. If you get this much, sell a 110 call for a $1.50, high probability, you're good to go. Let's move forward from this point. Okay? High probability credit spreads. So having walked through a few of the basics now, okay, we're now going to discuss high probability credit spreads. Because that's the focus tonight. Credit spreads are by definition option spreads whereby we receive a credit balance in the initial transaction. You know what that means when I say credit balance? Because that's the way the brokerage firm looks at it. What's a credit balance? That is money, money comes into your account. It is a credit balance. Everybody likes the idea, like, what'd you collect? I collected $1. Whose buck is that? It's your buck. Okay? Credit spreads are also defined risk trades, meaning you're going to know precisely the risk and reward prior to ever placing any trade. That's one of the greatest things about credit spreads. Credit spreads allow traders to dial in probabilities in trading. That means if you want an 80% probability of success, boom, you got it. You're going to know exactly which options to use. We're going to get into this here momentarily. Now, the many facets of credit spreads. Credit spreads can be referred to in a number of different ways. Now, tonight, you're going to hear me use some different terms. You've heard me say sell premium. You know what that means? Okay, sell premium. What does it mean? In this case, it's going to mean credit spread. It means, selling options. Okay, that's what it means. What's a credit spread? Well, a credit spread is selling premium. What's a short spread? Well, a short spread selling premium. It's a credit spread. Oh, bear call spreads. What is a bear call spread? It's a bearish credit spread. What's a bull put spread? A bull put spread is a credit spread. Credit spreads can be used. By the way, all these terminology, it's interchangeable. Credit spreads can be used to create both bullish or bearish positions. So I want you to remember, because people call this all kinds of stuff. They're like bear call spreads and bull put spreads and short spreads and credit spreads and selling premium. Oh my! You're like, but they all mean the same thing. We're just trying to do some credit spreads. We're trying to make them high probability. Now, let's get into it. This is a high probability credit spread. We're going to come in here and we're going to define the probability. Now, we're going to take the exact same example that we had earlier. We're going to go out and we're going to sell a 110 call for a $1.50 credit. Ready? We're going to sell it. What do you do when you sell it? You sell it. We're going to sell a 110 call for a $1.50 credit. Simultaneously, we're going to buy a 115 call, okay, for a 50-cent debit. There's a credit and there's a debit. There's a credit, there's a debit. Guess what? Add them up. You know what you still have? $1. Okay? What's $1? That is termed our net credit. But, however, and this is going to look scary, the maximum risk in this trade, you know what the maximum risk in this trade is? It's the differential between the call that you sold and the call that you bought. I want you to get used to this, okay? And literally say it with me. You sell a 110, okay, 115 spread. It's a 110, 115 spread. How wide is this spread? I don't want to know the credit, okay? I don't want to know the max risk. All I need to know is how wide is this spread. This is termed, and this is going to be critically important, okay, for the learning curve. This is termed, okay, a $5 wide spread. It's a $5 wide spread. Let me ask you something. What's the most you can lose in a $5 wide spread? You can lose $5. That's a $5 wide spread. You can lose $5. Okay? Why? You have to give, you're obligated to give somebody stock at 110. But you have the right to buy the stock at 115. I want you to think about this example over here, because let's say that the unimaginable happens. Okay? First of all, this is easy. If the stock goes down, these options expire what? Worthless. They expire worthless. You get to keep $1 credit. Bing, 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 bing. Easy, right? That's if the stock goes down. If the stock stays flat, bing, 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 you get to keep the credit. If the stock goes up, as long as it's below 110, ding, 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 you get to keep the net credit. But what happens if the unimaginable happens, right? And what happens if the stock goes to 100 and what? 20. The stock goes all the way to 120. But still, my heart, you're obligated to give somebody stock at 110, but you have the right to buy the stock at 115, right? Obligated, rights. Obligations, rights. What can you lose? $5. You can lose $5, of which you collected $1 up front. Maximum risk, $4. Everybody good? You never, ever had to own the stock, and you never will have to own the stock. Okay? I can teach you every variable in here so that you're not going to be exposed. But I want you to know that the differential between this spread, what's the risk in here? It's $5. It is a $5 wide spread, but you collected $1 up front. The dollar is yours. It's mine. It's my dollar. So the maximum sustainable risk then is $4. Good? Because now we're going to get a little bit more serious. We're going to take this to the next level. This is a high probability credit spread. Okay? The question that you might have at this point is, what is the probability? When I put the probability, the percent, like what's the percent? Is this a 70%? Is this an 80%? Is this a 90%? How about we actually teach you that right now? This is a short call spread. Now, here we just used a different terminology. Okay? We're talking about high probability credit spreads, and then we just jumped into short call spread. But guess what? They're the exact same thing. I'm getting you used to terminology, because traders talk about call spreads. Traders talk about short call spreads. Okay? This is better known as a bear call spread. Now, we have a stock trading at 200. Okay? We have a stock trading at 200. And that stock trading at 200, we do not own the stock. We have not purchased the stock. We're going to sell a 220 call. We're going to buy a 225 call. Now, let me ask you this one more time. How wide's this spread? Now, I'm intentionally doing what? $5 wide spreads, because I want you to be used to $5 wide spreads. Okay? It's a $5 wide spread. We're going to receive $1 up front. And that's very, very similar to many spreads. Okay? Now, this is going to freak you out over here, because I'm going to give you the probability right now. This has a 20% chance of losing and 80% chance of winning. How could I possibly know that? Because the credit defines the probability. Now, the credit defines the probability. Like, what? You want to know how to do probability of success? I'm going to take you through this a couple of times. Probability. I told you earlier, we looked at a probability curve, right? We looked at that probability curve. And what did we do in the probability curve? I told you, I could tell you the probability in those 110 calls. I could tell you, I could dial in exactly what the percentage is. You know, where we're talking about like a 30% probability or a 70% probability. Well, I'm going to show you now how to dial that in. Excuse me. In this trade, what is the probability of success? How do you figure it out? Well, you take the dollar credit. You have to know it's a dollar credit. In addition, here's the calculation. This is a $5 wide spread. the most you can lose in a $5 wide spread, okay, happens to be none other than $5, of which you received $1 credit up front. Definitive out-of-pocket risk is $4. All you have to do, and I'm going to show you this in another slide, all you have to do is take the risk, okay, take the risk in the trade divided by the width of spread. Nobody ever teaches this stuff. I don't know why. It's easy. The risk divided by the width of the spread. This trade has an 80% probability. And that's definitive. There's no if, and, or but about it. You could check, people are like, did you use a Black-Scholes model? You don't need a Black-Scholes model. The options pricing, okay, is going to give you the probability in the trade. The break-even point to the upside in this trade happens to be $221. Okay, that trade has an 80% probability. Timeout. Is everybody okay at that point? Right? Because what's the most important thing tonight? I want you guys to be able to leave tonight and be like, dude, I really actually learned something there. Because everybody, here's this, and it's a MACD and a Fibonacci and follow the bouncing ball. That's a bunch of crap. You got to understand probability if you want to be in this business. Okay? You got to learn it's the risk divided by the width of the spread. Know what your break-even point is. Let's move forward. Probability of success. Calculating your spread's probability of success. Take the real risk in the spread divided by the total width of the spread. We just showed that. The probability calculation details are as follows. You ready? Now we're going to show you a real trade. Okay, this is Tesla. Tesla! Dun, 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 dun. Couldn't have had a better trade. Now, you're going to notice something tonight. You're going to notice that I'm using a lot of what? Calls. I'm using calls. And the trades that I'm creating happen to be bearish. And the only reasoning for that, it's not because I'm bullish or bearish. It is because most people understand examples with calls rather than puts. Puts confuse people. Like, I got put the stock. Did you buy the put? Yeah. Well, you can't get put the stock if you bought the put. Did you sell the put? Yes. Oh no. I'm not sure if I bought it or sold it. And they get confused. I want to make sure that you get it because tonight's about probability. And if you find the right probability and you learn how to do this and you actually go through the checklist to how to do this, okay, I'm going to show you exactly how to get edge in these trades. That's what this is about. It's about edge. It's, just understanding probability isn't going to make you money. You got to learn step by step how to get in, how to get out of that, right? So here's a trade. Tesla, okay? This is a 360. This is a real trade. I took the screenshot today. This is Tesla. The trade happens to be short duration. It's only February 9th. Okay? I'm selling a 360, 365 call spread. And let me ask you, what is the width of the spread? Okay? The width of the spread's right there. It's $5. The credit received is right here. That's the credit received. It's $1. So what I want you to do is the real risk. Okay? Real risk is the width of the spread minus the credit received. Okay? You're like, what? Okay? Think about it. Real risk. Real risk divided by the width of the spread. When I say real risk, what's the real risk? The real risk in the trade is $4, right? It's a $5 wide spread. The most you can lose is $5, of which you collected $1 up front. So if you have a $5 wide spread that you collected $1 up front, your real risk is $4. Just take the $4 divided by 5 equals 80%. Now, I can whip out the calculator over here. You could do it, right? Literally take a calculator, divide 4 into 5 equals 80%. Yada, yada, yada. That is an 80%, and I want to be definitive about this, 80% chance, okay, of making 1 penny or more. It's an 80% probability of making 1 penny or more. And it's kind of weird but that is the real definition of it. It's an 80% chance of making 1 penny or more. Do we like it? Do you like the trade? Do you like knowing that you have an 80% chance of making 1 penny or more? I could have dialed this trade in. I could go right over to the trading application right now, and I can get you a trade with a 90%. I can get you a trade with a 75%. I can get you a trade with a 70%. Let's do it again. Okay? Let's do it again over here. Again, the real risk divided by the width of the spread is definitively the probability in the trade. And again, people are going to, they challenge this and they go, well, I'm going to go look and I'm going to check out a Black-Scholes model. I'm going to check out this. Even if you're an engineer, trust me, this passes the sniff test. Okay? This is the way that probability was calculated for, and it's before anybody had like all the different models and all the different computers over here. But this is how you and me, need to look at spreads. You don't look at a spread and go, I'm collecting $1 up front. It doesn't matter that you collect $1. You need to know what the probability embedded in the trade is. That is the most, important thing. Now, probability alone does not mean that you're going to make money. And I'm going to come to that here momentarily. Before that, let's do another one. Let's do another trade. Let's do another trade in Amazon. Amazon is trading in and around all-time highs. Every day it's an all-time high. Let's sell an at-the-money spread. Now, here, this is Amazon today. Now, when I took the screenshot today, Amazon was trading at $12.47. All I'm thinking is, hey, maybe Amazon can go up, maybe it can go down. But if I sell options way out here, okay, and hey, can Amazon get all the way to $12.80? Maybe, but I could still sell it. I could find out. So I'm going to go out there and I'm going to sell, the 1280s. I'm going to turn around and buy the 1285s. Okay, now it seems kind of wild, but you think about this. Amazon could move up another $30. It's capable of doing that even in a day. But you got to know what the probability is in this trade, right? Okay. Now we know if Amazon stays flat, I make my money. How much money? We'll come to that in a moment. If Amazon goes down, I make my money. Even if Amazon goes up, you'll have some heart-pumping days over here. But one of the things I want to show you, when people look at trading and they want to know, how do I really make money in this trade? I'm going to tell you exactly how you make money, okay? And I'm going to show it to you one more time. How do you make money in this trade? Anybody can teach you to sell a 1280 and to buy a 1285. Anybody can teach this, okay? What anybody can't necessarily teach is the fact that why this trade happens to have some edge. And I'm actually going to show you this in just a brief moment, okay? If Amazon is to move against you, all right? Now, Amazon can move down. If it moves down, you're going to make money. If Amazon stays flat, you're going to make money. But if Amazon starts to trickle to the upside or even explodes to the upside, okay, here's the logic. What does it take? What does it take for Amazon to move from 1247 all the way to 1285? Now, again, it's Amazon and it can move, $15-20 in a day. But what does it take? And when I say what's it take? Okay? I mean, Amazon's got some volatility over there. And the answer is it takes time. And as time moves forward, guess what? Options already start to decay. And what a lot of people don't realize is when you're doing trades that have an 80% or 70% probability, time, is the friend. Because the moment that you put the trade on, the time starts to bleed out of the trade. And if you understand, how to take advantage of time, you can actually control your risk as the stock starts to move up to you. And that's, again, it's a huge aspect that everybody doesn't fully recognize about, hey, why does everybody talk about selling options? All right, most people have no clue. There's a lot of people that go out there, they've been selling options, they teach to sell options. They don't know what they're doing. They don't know how to mitigate the risk. They don't know that just sitting there, I have an 80% probability. That doesn't mean anything. Because 20% of the time, you're going to get hammered. Let's look at this trade. Okay, this is a real trade. I mean, this is something I took a screenshot of literally today. And in this Amazon spread, right, there's Amazon trading, right, for 1247. I'm selling the 1280s. I'm buying the 1285s. Now, in this trade, you do the math. Come on. You do the math. How wide is the spread? Come on. What's the width of the spread? It's $5, of which you received $1.50 up front. So what is the definitive out-of-pocket risk? What's the definitive out-of-pocket risk? $3.50. It's $3.50. $3.50. Okay? How do you figure out the probability? Take the real risk. That's that number, $3.50, divided by 5. Okay? Do some quick math. Boop, 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 boop. This trade has a 70% probability. That trade's got a 70% probability of what? Of making 1 penny or more. Now, I'll actually map it out for you. And everybody that's coming tonight, you have this PowerPoint. You'll have the PowerPoint. Okay? Because I want you to know how to do this probability stuff. because this is trading. Amazon, okay, we're selling the 1280s, buying the 1285s. The net credits for $1.50. Max risk is $3.50. Width of the spread, hey, we just said it's $5 wide spread. The probability calculation, 350 divided by $5 equals 70%. Okay. Now, let's look at this. Because again, we want to discuss 70% probability. Doesn't necessarily construe you're going to make money. 70% probability and the 30% hammer. 70% sounds great. And I told you, you go to some website, and some website, like, I want you to think about this for a second. Some website would be like, I have been right 90% of the time. You know what that means? Nothing. Why? Because 70% sounds great, but 30% of the time, the market's going to rip your face off. That's why when somebody says 90% of the time, yeah, well, 10% of the time is the hammer. Okay? I went for 70%. I didn't want to get crazy. 70% probability in what I call the 30% hammer. Again, it sounds great, but 30% of the time you get what's called your face ripped off. I love to, put that on a high note over there. When you trade high probability strategies and you're wrong, you're going to get hammered. That's what you need to learn to control. And I'm going to tell you something, because many of you listening tonight, all right, you have actually traded. Come on, how many people have actually sold spreads? Admitting it is the first step tonight. How many people have sold spreads? It's okay. Chat in. Listen, we're all here. You have. Okay? Roy, Brent, Roger, David, Jim, Sam, CB. David, I mean, the names are going by so fast. Tons of people. Great. You know what this means then. That's why I actually put a slide like this in here. Because I want you to realize, first of all, I know what rip your face off happens to mean. I've been trading for 20 years. Just because I worked at a brokerage firm, people think, are you allowed to trade when you work at a brokerage firm? All right. When we started up thinkorswim, we were our own biggest clients. People, I trade. Okay. I know what getting your face ripped off is about. When you trade high probability strategies and you're wrong, you get hammered. And the market's evil. It's evil enough to allow you to make money 3 or 4 times. You increase the contract size. It like lures you in. It's like, come on, come for it. Then train wreck. Your losses are going to exceed the gains on the previous 3 trades. And if you haven't been through that, you ain't never traded. It's like I can see your account. Well, for the previous 15 years of my career, I did see your account. Like, how do you think I know some of this stuff? I watch people trade. That's one of the great things about working for a brokerage firm. You get to trade and you watch people trade all day. And then wait, it gets worse. Then you go, I can fix it. I know I can fix it. Somebody taught me to fix it. Fix is a really dirty word in trading. You want to fix something? 15 years in the brokerage business. Totally cynical regarding good trades gone bad. Totally cynical about this. Good trades gone bad. Anytime you're fixing a trade. Let me tell you what you're doing with fixing a trade. You are adding more risk to an already losing trade and racking up transaction costs. What's the first rule that you learn in this business? Okay? What's the first rule you learn in this business? Don't add to losing trades. Do not add to losing trades. Like, how hard is that notion? That's the first thing you learn in the business. Yet everybody goes, I'm not adding to a losing trade, sir. I'm fixing a losing trade. Oh, are we having vocabulary problems over here? Fix and add? That's the same crap. Yeah, some fixes may work, but the very notion of fixing a trade throws more good capital after bad. Throw it out like yesterday's trash. Here, best analogy I've ever heard. Take a car, drive it off of a cliff, and bring it to a body shop. What's the body shop going to say to you? The body shop will tell you the same thing about the car that I am going to say about your losing trade. It's a piece of junk. It's garbage. Let it go. Do it right. Learn, how to correct good trades gone bad. It's the whole key to selling spreads. People don't understand. You have to get into the trade perfectly. You have to know the right probabilities. You got to know what a good trade gone bad really means. Would you like to learn how to sell spreads and how to control your risks the right way? Let us discuss criteria. That's what we do here at TheoTrade. It's criteria. It's what we do at TheoTrade. Trading is all about It's all about answering the what ifs. First of all, what is criteria? It's a recipe. You want to bake a cake? You got a recipe. You want to trade? You have a recipe. That's what criteria is. You need to know what might be a good stock ETF candidate for me to sell a spread. You could use a stock, an ETF, an index, the SPX, the QQQs, the spiders, Apple. What is a good candidate? What's the correct options expiration? Okay, that one, gold. You don't have the right options expiration, you're dead. I'm going to tell you why. Did I talk to you about time? Yes, I did. How do you get edge in a spread? The decay. Pick the wrong expiration cycle, you're toast. How much capital do I commit? Because they can be a little scary. There's trades, people. You're going to risk $4, okay, to make one. And you're like, I can't risk 4 to be able to make one. Why not? That trade has over an 80% probability, okay, embedded in it. That's what risk 4 to be able to make one means. But you're going to learn how to do it the right way. Which strike price options do I sell? What strike price options do I buy? That's what the what ifs. And that's where TheoTrade has the answer to all of those questions. We have the right probability for my trade. We have how many option contracts for your account size. You can do this in an IRA. You can do this, okay, in a margin account. Yes, you can do it in an IRA. People always ask that. I trade in an IRA. Starting in 2018, I'm an IRA guy. I'm going to be 42 years old. I started trading when I was 22. I'm going to be 42 years old. And the accountant finally said, hey, trade in IRA. Okay. I do everything in the IRA. I even trade futures in my IRA. When do I close my short spreads? How do you close it? What if the stock sells off big? Do I bail out of the short spread? What if the stock rallies massively? I mean, come on, that's all we've seen the last 6 trading days. Can I fix a losing trade? Can you fix a losing trade? Oh, we're not going to be fixing any losing trades, are we? We have the answers to all the trade-related questions. Again, what we do here at TheoTrade is we build recipes, we build criteria with definitive answers and checklists for each strategy and each unique variable you're going to encounter. And that sounds like a lot, but what can happen? The stock can go up, the stock can go down. Can you be assigned early? Like, what's my risk? Is there a dividend coming? What about earnings? Like, think about this. How, when, why, at what price? It's totally overwhelming. Have you ever looked at an option chain? There's weeklies in there and there's monthlies and oh my, there's thousands of strikes in each individual product. Then you have earnings. Earnings are approaching. What steps do I take? Take evasive maneuvers, right? Can I sell options without ever owning the stock? Of course you can. You can do this, okay? You got to have more than $2,000 in your account, but that's it. This doesn't need to be, You don't have to have $2 million in your account. You don't have to have $20,000 in your account. You do have to have more than $2,000. But these are just the beginning. This is just the beginning of the variables you're going to face while selling a credit spread. The secret's always going to be in the sauce. Everybody thinks to themselves, hey, I can read about selling spreads anywhere. You know what? Let me tell you something. You can. There'll be 1,000 sites that are going to talk about selling spreads. Literally 1,000, maybe more. Now think again. Because this is not about selling a spread. This is about criteria. The following strategy means nothing. It's all about the corresponding criteria, and it requires the utmost attention to detail. We spent years fine-tuning these trades, okay, and the setup and the criteria. And we approach, the section on criteria. You got to follow the steps to build the trade. You want the criteria to build the short spread? We have a class. It's a guide to selling high probability spreads. I am the trade instructor. This particular class, it's a 4-hour course. It is available immediately. It is one of the very few courses because of the complexity and the detail in the criteria. We have pre-recorded the course. It's pre-recorded. It's ready for download tonight. It's a 4-hour class. And again, when I say you can stream it, you can start watching it tonight. Available immediately, unlimited access, and you can download. And what you can download is all the criteria. It's the checklist. It's the actual slide deck that I use. It's a PDF file. In addition to the course, and I'm going to show you the different course. By the way, the course, it's $199. People are going to lose more than $199 trying one spread and not knowing the right criteria. And I'm telling you, I hit on those sore points because I know that every person in here, I know when people are in here and they've sold spreads, they're not hitting upon the right criteria. That's what it's about. Okay. And I'm going to talk a tremendous amount, okay, in this course. Again, it's all pre-recorded because there was infinite complexity in putting it together. Huge amount about probability of touching and knowing the exact options to sell. And then more importantly, how to get out of these positions. Additional bonuses. We wanted to give you a little bit of prerequisites for the class. Options 101. It's the basics and beyond. You got to go back. Do options 101. I don't care if you're the most experienced traders in here. Okay? Do it. Bonus number 2. It's options 201. Verticals and calendars essentials. People, these are 5-part series. Then we come into options 301. Options 301 is volatility essentials. But you know what volatility essentials is really about? It's about probability. It's everything you're going to need to know about probability. I got a better one for you. On the 4th bonus over here, we're going to give you a probability calculator spreadsheet. You don't have to do, what's the real risk, okay, divided by the width of the spread. How about we have a calculator to do that for you? And we'll teach you in the class how to use the TheoTrade probability calculator spreadsheet. Okay, you sign up for the course right now. Just download the spreadsheet. It's yours. Okay, you ever lose it? Don't worry. We'll give you another copy of it. In addition to all of this, we're going to give you a 1-month access pass to TheoTrade itself. That has over 2 years of coaching archives and chat room sessions. Okay, and the 1-month access pass also will give you access to the live trading room. Bear with me for a second. People, there's a lot to discuss. Everything is $199. We want to give you just an absolutely unbelievable experience at TheoTrade. Like, again, you go to some course, you pay $500 here, $500 here, and $500 here, and you start spending all this money on courses. It's $199. Okay? And it's going to give you a month. And I'll tell you what, in a month, okay, binge watch like you would on Netflix. You know what? Hey, don't go watch the next series, on Netflix over there. Most of the series are ending anyway. Come in here and spend a month in there. And I'm going to show you what that room looks like. I'm going to show you what a 1-month access pass looks like. Because as important as this guide to selling high probability spreads course is, the 1-month access pass to TheoTrade, it is unequivocally, all right, going to be the best experience you've ever had in trading. There's so many archives, and there's 2 years of archives. Anything you ever wanted to know about trading, you'll find in there. You got a month pass. Also, this course will qualify you for reduced commissions rate. That one happens to be specific to TD Ameritrade clients. If you are not a TD Ameritrade client, we will give you a link. In fact, we'll post the link, okay, into the chat right now. So I'm going to continue on over here. By the way, the web address, go to theotrade.com/trade. theotrade.com/trade. In fact, I'm going to throw that up there right now just so everybody sees it. theotrade.com/trade. We can also post that link in there, right? Here's the curriculum for this class. How to sell the correct spreads to maximize the benefits of time decay. I talked about time decay. Okay. And again, after I go through this curriculum, I got to show you what you get with the 1-month access pass, because we've only ever done that like one time before. People are totally blown away by what we offer inside of TheoTrade. And again, we want you to be totally blown away. If you're going to spend $199, and this is not a rhetorical question, you're going to spend $199. Do you want to be overwhelmed or you want to be underwhelmed? Because I'm going to tell you right now, no one has ever come through any of our courses and ever said like, oh yeah, that wasn't enough for me. Nobody ever says that. They go, holy, that is unbelievable. And again, you're going to be binge watching some stuff for the next month. It's not going to take hours a day. Okay. Put a little time, put a little effort, but realize that you do have access to 2 years of archives if you want it. And you're going to want to check some of that out. How to sell the correct spreads. We're going to give you definitive entry and exit criteria. It's the key to consistent returns, so you're never going to left guess. You're not going to be left guessing what options to trade. How to identify favorable short spread candidates. You're going to know precisely, again, precisely what stocks to trade this on. How to identify your risk and your reward like never before. So you're going to know exactly, okay, how your spread will perform in all market conditions. There's not going to be any ambiguity to this. There's no give and take. You're going to know what you can make, what you can lose, what the probability happens to be. In addition to it, this is a lot in one course. Powerful strategies used by, again, many of the market makers and insiders to generate consistent returns. Why so many experienced traders sell spreads. Okay, and again, we're going to talk about, we already did, why volatility is going to pick up. What's going to make the best candidate. Okay, when to open these, when to close these things. This is also a huge portion of the course, the probability of touching, and how this calculation can be the defining factor in everything that you do, all of your trading strategies. The probability of touching in this course is essential. Okay, and it blows away. If you've ever heard anything about probability of touching, it'll blow it away. You're going to love what I talk about with probability of touching in there. Now, this is just a screenshot. This is the probability calculator. This is the spreadsheet. All you have to do is input, okay, some of the prices, and it will give you the probability of success in the trade. It's that easy. You don't have to go through the crazy calculation. You just input a few variables. We will walk you through this spreadsheet. A spreadsheet scares some people. They scare me. We're going to walk you through how to do it, how to just enter some variables, and it'll just spit out the probability of success in there. Now, in addition to this, and this is the part that I really strive for people to understand. Again, this is TheoTrade.com/trade. You're going to have a TheoTrade 1 month access pass. What does 1 month access pass even mean? Right? First of all, you have access. The reason that you're signing up for this, it's the Guide to Selling Spreads course. We're going to teach you to sell spreads correctly. We're going to give you the right criteria. Okay? In addition, everything that we will do online for the next month, okay, live and archived. We archive everything. If I talk, it is archived immediately. We have daily coaching sessions. Daily coaching sessions. We do 2 daily coaching sessions a day. By the way, we broadcast 5 hours per day. Tomorrow's Wednesday. Oh, Wednesday is our most full day. Wednesday is the most full day. I kick off for the first hour. Hour number 2 is Doc Severson. Okay. Hour number 3 is Jeff Bierman. Okay. Hour number 4 is actually Slim Miller. Hour number 5 actually goes over to Tony Rago. Hour number 6, okay, belongs back to Doc Severson. And we have an options happy hour tomorrow night. And the happy hour, it's an evening webcast that we do the same time as tonight, 7 p.m. Central Time. That's going to be Corey Rosenblum. Okay? We haven't even talked about Corey yet. Yeah, he's still, he's a newbie here. So tomorrow is like 7 hours. It's all going to be archived. It's like, oh, I'm totally overwhelmed. It's okay. You don't have to watch all of it. Hey, come in. We'll check out the highlights in there. So it's a live trading chat room. We're providing real-time trades in there, real market insights. Whether you're an intraday trader, whether you trade stocks, options, futures, we have something for everybody. You have access to all the archives. Okay? In addition to it, there's a start section. There's a start here because you're like, I'm overwhelmed. I don't know what I'm doing. Well, let me actually show you what that looks like. Okay? This is the site. This is actually our site. This is what we call, the member area, TheoTrade members area. You can watch a video on a little bit about it, but you can come in here and start searching like, I want to know everything there is to know about bonds. So type in bonds. All right? I just want to know everything about bonds. Good. Coaching session. Okay? Bonds, rates, and the yield curve. Why traders are watching bonds. Okay? European junk bonds now yield more than U.S. Treasuries. Insane. Okay? I mean, all you got to do is click on this. What do? Okay? Now you're watching it. That's 1 hour long. That's it. That's the archive. Okay? Go back. Whoop. Don't. Okay? Go back in here. If you want to start, let me log back in. Sorry about that. If you come back in here, by the way, they're here to help you. That's one of mine. That's one of my babies. So if you come in here and you go search, all right, you can search for innumerous ideas. You can say spreads. I want to know everything there is to know about spreads. Okay? There's going to be 50 different examples. Junk bond spreads, selling spreads. It just goes on and on and on. Coaching session. Okay? Why we use vertical spreads, credit spreads. Okay? Risk twist spreads. You name it. You can type in calendar spreads. You could type in volatility. Okay? You name a topic, And I bet you that there's a session in here. All right. We just typed in the word calendar. Here we go. Calendar spreads for low volatility, Redux, part 2. It goes on and on and on and on. In addition to it, let me go back to the home over here because I want to show you a few things. Okay. There is a section that says start here. You know what start here is? These are all the introductory videos. Order execution. Okay. I will challenge anybody. You go through order execution part 1, 2, and 3. You don't think that that's worth $199? Okay? Email me. Those 3 courses, nobody understands how orders are executed better on the education side of this business. Okay? I helped build the order router for thinkorswim. We'll explain stocks, options, futures in there. The order execution alone is worth $199. You have access to all of this stuff. Okay? You are going to absolutely flip out when you realize what you really do have access to. Then you can come into our chat room. This is where we're live on a day-to-day basis. This is it. This is a video player. Okay? This is the chat room down below. You can talk to any of the other traders in here. I'm telling you, you're going to absolutely love this stuff. Okay? In addition to it, we will email trade ideas to you, and we will give you any and all of our proprietary indicators. You know, a lot of people, they'll charge what? You know what? You want to get your money's worth out of us? You come in here, okay? Look under member chat room and go shared charts, scans, and studies. Okay? Just go in here. Take a look. All of these are proprietary indicators. These are indicators that we built. All right? Individual, Don, Doc. Look at all the different things that Doc has. Jeff Bierman, Tony. Okay? Again, all of these. All you got to do is copy the links. And there's multiple, platforms in here as well. Again, you're going to flip out when you see what we have. Things like expected move calculators in there. You're absolutely going to love that. Now, let me take you actually over to the page because there might be a little bit of confusion in here, and I'll make sure everybody gets it right. Okay? The web address to enroll for this. Do it tonight. It's a special. TheoTrade.com/trade. The whole thing is $199. Okay? We want you to experience what TheoTrade is. Again, this is the Guide to Selling High Probability Spreads course, okay? In addition to it, and it'll explain this, all the bonuses in here, the TheoTrade Probability Calculator, options 101, 201, 301, okay? A discounted rate at TD Ameritrade. By the way, I cannot mention that live, but if you want to know what the discounted rate happens to be, you can come in here and you can ask. One by one you have to ask, and we will fire that back to you. The major discount is a discounted rate on your options commission. I think you guys will love it. I mean, that alone will save you more than $199, but that's not why you come to TheoTrade. You come to TheoTrade, they're going to give you, again, a 1-month access pass to it to continue your education. And I'm telling you, you're going to have questions after this class. That's okay. If you have questions, email us. That's what we're here for. Okay? You want the email address? It's right there. support@theotrade.com. There's the 800-256-8876. Again, theotrade.com/trade. Now, I am going to come in here and I am going to answer just a handful of questions. Okay? So everybody's got questions. First of all, can I do this inside of a retirement account? And the answer is absolutely. Without unequivocation, the answer is yes. As I said, I currently trade now, okay, within an IRA. And I'm pretty much solely in the IRA. Now, another question that came in here, somebody said, can't make it live, okay, is everything recorded? Everything is recorded. When I say everything is recorded, like I'm not kidding, everything is effectively, all right, recorded. And by recorded, I mean, here's the archives. The member chat room, the coaching sessions. You want to see Doc's archive, Jeff's archive, Slim's archive, the classes archive. Like, it's all recorded in here. You have access to all the coaching sessions and all the live trading sessions. Okay? And any classes, like if we do a class, okay, in a week, you'll have access to it. Why? We can't turn you off. You have access to TheoTrade for a full month. Okay? Now, Michelle actually asked a question. She said, I can't get my head wrapped around options. Will I be able to follow along the class? Yes. I mean, that's why. Okay, Michelle, that's why we're doing the options 101, 201, and 301. Like, we believe heavily in prerequisites. And, so many times you go to a class, you're like, I don't even know what's going on in here. We don't want you to start that way. I mean, listen, this needs to be a positive experience. Okay? If you don't learn, if you don't make money, what good does that do us? It doesn't. Okay? It's got to be a win-win out there. All right. I like this. I have a 6-figure retirement account, but Social Security is not going to cut it. Is this going to help generate some income? Michael, that's the exact design of the class. It's an income and a premium generation strategy. I'm going to tell you right now, you got to learn the right way to do this. You got to learn that you're going to have some drawdowns. Okay? But we're going to show you how to get edge in these positions. And that's the single most important aspect of it. Okay? Another question in here. Gloria said, I can't get approved for options because I'm a newbie. We will help you get approved for options. That part, easy. Okay? So if you're new to this, you don't have options approval. The one thing, you have to have more than $2,000 in your account. We will get you options approval. Again, to order it, it's just TheoTrade.com/trade. TheoTrade.com/trade. Click add to cart. Again, if you have questions, we're here. Okay? It's again, we're here for you. To continue on over here, I think I got most of them. I like this one. I lost money on some spreads, and I'm finding it hard to pull the trigger. Will the class help? Okay, that's where I believe is probably the area that I can help most. If you've never been to any courses that I've ever done before, is I don't do well with just theory. I'll bridge the gap and take you into the literal and try to get you guys in and out of trades. And that's also, one of the reasons that we feel so strongly about doing this, hey, it's a 1-month access pass to TheoTrade so you can continue your education. The reason we're doing the 1-month access pass is to take you from theory to literal. And when I say literal, you got to be able to place a trade. Everybody's like, oh yeah, it's easy, no problem. Well, you know what? People get freaked out when they're first placing a trade. And I'm going to be there to actually support you. Listen, I watched traders for 15 years from the brokerage firm perspective. I know what works and what doesn't. I mean, that's how we developed a lot of the criteria that's in these courses. And that's what matters to us. Okay? So it's all about execution. So Robert had a question here too. Does the course teach you how to avoid assignment? Yeah, there's actually a discussion specifically in the class about not getting assigned. Listen, I don't want you to have to face that. It's not like, the end of the world over there, but absolutely talks, okay, about the fear of assignment over here. Now, somebody said, do we talk about implied volatility? Yeah, the course actually does have an entire section about implied volatility. Not so much historic volatility. It's more implied volatility, John. So, by the way, somebody said, what's the timing of most of your credit spreads? David, that's exactly what the course is going to cover. That's the criteria. When somebody says, what's the timing? All right, I will give you a lot. I will not give away my criteria. I mean, that's what we charge for. I mean, I'll tell you everything there ever is to know about the strategy of a vertical spread, the strategy of a credit spread. But people pay for TheoTrade. The reason people come to TheoTrade is we got criteria. I mean, it's recipes. And that's where, education kind of drops off. You read a textbook, nobody says, this is the strike to use, this is the probability. And quite frankly, that's the stuff when I worked at a brokerage firm, they wouldn't let us do it at the brokerage firm. You can't be that specific when you work for a brokerage firm. Somebody said, does this include options on futures? Yeah. By the way, we also have an archive. We have archives about options on futures. I trade options on futures as well. Okay. You can do this in the off hours too. All the orders we talk about, you can use good till canceled. They're called GTC. And if you've never heard of that, we will talk about GTC, good till canceled orders, which means, because so many people today, they're like, listen, hey, it's great, Don, but I work for a living. Totally get it. One of the reasons we do some classes in, off hours. So by the way, GTC orders, we do some classes in some off hours. And the reason, okay, that we'll do classes in off hours is so that people that do work for a living, like tomorrow night, we'll do this options happy hour at 7 p.m. Central Time. You'll kind of get it. By the way, if you're curious and you go into the site, you can actually come into the site and you look through the different resources, and we have a calendar. All right, we have a member event calendar, and this calendar will tell you like, hey, when's everybody on? I told you tomorrow. It's Don, it's Doc, it's Jeff, it's Tony, it's Slim. It just goes on and on and on. It's Don Kaufman's happy hour. Tomorrow night, though, I'm not doing it. It's actually going to be Corey on tomorrow night. But again, we have a full calendar in there as well. So I think you guys will really appreciate not only the guide to selling high probability spreads course, but again, you join us for that month in there. And even if you can't join us live, everybody has time to visit those archives. And I tell people for like a month, hey, go Netflix free for a month. Don't look at Amazon Prime for 1 month. It'll still be there. That's the great thing about Amazon Prime. That's the great thing about Netflix. Still be there. Well, guess what? For a month, dedicate to actually learning some of this stuff. You're going to find that inside the month, you're going to want to start watching it. You're going to be up like late at night, like, I need to see the next section. How is this going to end? It ends with the market rallying. With that, I want to thank everybody for joining us tonight. Again, it's TheoTrade.com/trade. Thanks, everybody. We'll be here for a couple of more minutes to answer questions. And again, you can always reach out to us. Support at TheoTrade.com. Have a great evening, everybody. Bye-bye.